Hello, welcome to another episode of The Value of Everything. I seem to have quite a good response, probably just because I've got like a title that outlines Greece and economics and China, that they seem to get fairly high hits. So I am going to try my very best to provide you with something of a tad piece of value in terms of a little perspective on economics. Before I start, just to let you know that you should never take any financial information from some strange man from a podcast. Always seek out the expert as you can. When you are provided with my information, always deduce it and apply your own logic and use your own thinking. If you think it's correct and you are deciding that it's correct, not just taking my advice, then yeah, that's your choice. You go ahead along with it. But I do not want you to go off and go and buy a whole load of gold and then the gold market crashes all of a sudden on you and you're going to despair and then try and hunt me down. So that's just that point. Now, topics of discussion. Let me just get out of this car park. Damn it. 1 second. I've got the wrong card. Okay. Topic of discussion will be China. It seems to me that there's been some interesting little phenomenons occurring in the terms of market manipulations. Now, I think I've mentioned this a few times before, that China is seems, or the evidence that is put forth before me and what I perceive, they seem to be liking to play around with statistics and playing around with markets. Yeah, I mean, I guess these parts are you're playing around with free market elements, which the government really shouldn't be doing. It should be just like turning the blind eye, let the market sort of rule itself and regulate its own self, let it flourish, and then go ahead and extract the fat from the land. Yet we have China, which is still, you've got to recognize that it's in a state of it was in a long state of communism, and you have communist parties. Have I got my stupid on? Oh, no, sorry about that. Just realised I've got some bloody milk on my seat, and then the alarm's gone off. Sorry about that. Sorry. Everything's okay. There's this little sensor that if you're sitting on the passenger seat, then an alarm comes on, which is a good safety feature. Highly irritating, but if you should be blasé enough to forget putting on your seatbelt and driving around like a madman, then it's fantastic. Now, let's go back to China. So China, they like to play and be in control of things. They, I guess, have a little bit of a fear of market forces. They would like to have obviously, if as a government, you would like to have the strongest government in the world and the largest territory in the world to extract the most amount of tax as possible as you possibly can. That is the motive of a government. It has to confines around the realms of reality. And it has to be realistic in what it's possible that it can do. Now, China is in a fairly strong spot when it comes to other nations. It does create a nice surplus of money. So you have an export and import expenditure, and it would seem that Chinese are very good at putting by a lot of their money and will have a trade surplus. With this trade surplus over time, they like to purchase assets. And they like to build upon the infrastructure of the nation. So you will have the Chinese, which will be buying a lot of US dollars, but they don't necessarily do that anymore. Or bonds. They want to step away from that that position, and they like to purchase. Accumulate, not purchase. Well, they do purchase it with their yarns, but they like to accumulate gold, and they keep their own reserves, and then they like to purchase these big plans to improve their infrastructure, to get these fantastic bullet trains and everything else, and hey presto, that's what happens when they are centrally planning their nation. The problem with centrally planning their building of their nation is what they want, but maybe not necessarily what a commoner from China maybe want. So, commoner from China might not want this big, very expensive, 20 times the average earnings apartment, and probably just requires a fairly far more humble shelter where they can accumulate their own wealth more and not be into a savage amount of debt. So there's these little things going on with China. Now, what we've had recently is the Chinese market has the Shanghai Composite Index has been highly volatile, with the market fluctuations going up and down. And China's been stepping in and been very concerned at a number of times when the volatility has kicked into certain extents. Now, with this volatility, the way that they cure this, now I guess when we talk about volatility, we're looking at massive movement, big swings in a positive direction and a negative direction. With regards to China's perspective, or the state's perspective, they're quite more than happy to see a surge up, an uptick in the market. However, they are a little bit concerned when it comes to a downturn in the market, particularly with the knowledge that there is a hell of a lot of speculation in the market. There isn't big institutional investors like there are, but not quite so many. There's more speculation-based investors who have traded on margin and put a little bit of their collateral up forward to have this massive risky position on top of another risky position on top of another risky position. So it means that if they get called out, they have to rapidly jump out of their position, and it creates a number of sell orders or short orders, So you have this extreme swing, and you have when you have big margin players, you get people that want to put a bit of skin into the market, make a big dime, and then jump out of it as well. And particularly when you have followed big market events in Greece, disturbances, and there's a lot of bad news swinging around, it all adds up to a lot of volatility happening into the market. Now, what we heard last week is that the Chinese would walk in, would put certain bans on the market. So at first, the old traditional way is to stop any trading which occurs on the market, just because everyone was to calm down the market, just make sure that there's not any rash decisions that are being made. And then switch on the market. But there's been these free fall moments, and the Chinese haven't been able to stem the free falls, even with the pauses of the market. So fundamentally, there is a lot of constraints on the positions of people once the market starts to go negative. You've got this ever-increasing need to get out of the market the more it goes lower. So there's an incremental issue when the market starts to flow down to a lower level, which I've got this opinion where, like, you would have this little room where these government administrators are all standing around going, "Oh my God, look at this market. Let's try and see what we can do, what we can do next." Because we do not want to have a sell situation on our hands. Now, China's very interesting. I would love to do a little bit more research on this, just to get in, but I've just flowed it all out here and just see how it goes. China's very interesting in the terms that they have got short-term goals and long-term goals. Their long-term goal, I would expect, is to float their renminbi or the yuan and be the international backed currency, backed by all the gold stocks that it has on its books. So it's got gold deposits, and it's got a large, massive currency, and then people can purchase into that currency. And it's a globally traded currency, and basically China has there are a few other little things which happen when you have the global winning currency, which the US dollar has been for quite some time. I'll try and provide that to you in another presentation, but the long term, so the short term is to accumulate a ton load of wealth, to build up a massive impregnable infrastructure system of China, where we pour all the people out of the peasant fields and start to bring people into a industrialized environment, and then even possibly go into the next territory of like a big service industries and high-tech industries, which China's more than like is pretty much covering a lot of those bases already. So just see it from that perspective. They're doing pretty goddamn well with all of those sort of objectives. Now the problem that they have is they have to convert from this this lovely system where they've pegged the US dollar to a certain extent. That pegging is easing off as time progresses. And then with that pegging of the dollar, they are going to release the renminbi, let it become an internationally backed currency, which will be put onto the markets, internationally traded, and there you have the birth of a new super empire sort of thing. So you've got like a rounded. You're basically trying to convert China into it's not westernized industrial sort of country, but I guess in certain terms they want the lifestyle and all the joys that it brings from being a high consuming energy, high earning, high powerful. You've got all the services and industries working around you in this super-sized country that you have with this massive amount of money. Don't think I've been really trying to explain that too well, but just see it as a future big America. That's that's basically the idea to create. And then so we have certain issues and obstacles with China's situation. In that is that they are a massive export country. And for them to start doing that and to float their currency, they would have to do a big conversion of converting a lot of their goods into, a lot of the goods would be an importing country. I know that, I think there's some fascinating facts about iPhones in China, about how many they purchase. Probably one of the biggest markets is China in itself, and there is obviously it is the modern day status symbol to be walking around with a little flashy, the latest model of the not the iPod, the iPhone. So we have all of those little elements which are kicking in, and it's a little bit of a headache, and it's particularly when if China would be going quite nicely if the global economy wasn't in such a disarray. But it's unfortunately not in that, and it's actually trying to fund it. Well, it was for a long time funneling money into all of its. Well, it's paying off a lot of its debtors anyway, so that it can still provide more goods to the nation in itself. So if you look at the China's debt situation, where it purchases other countries' bonds, is basically giving countries liquidity in the now so that it can purchase more of its goods and put off things for the future, so that people and taxations, and there wouldn't be much more of a clampdown on the people and the public purse to purchase more of these goodies from China. So but even though they're trying to restrict and remove that to a certain extent, if you think of it, China's becoming almightier with their surplus, and yet at the same time they are supplying the greed and exposure of other nations. Very interesting sort of play on that, and probably from a Chinese perspective, it's like a bit worrying, because you're like, I'm paying off this guy, I'm giving this guy some money to buy some more goods from me, and I keep on loaning him some money, but I'm really like, it's fantastic that he's paying for all these goods with my lent money, but I really can't see how he's going to make the cost of all of this in the future, and that's the sort of typical thing. So maybe China has a certain strategy to know that this is not a permanent thing in the future. And one of the major things that China likes to do is acquire a lot of gold, and it is one of the biggest producers themselves of gold. And with all this wonderful gold, it gives them a lot more credibility for their currency. Now, when the reason why you like to have gold in itself is that it is the last beckoning, it's the last call to arms when your currency is being trashed, because you can pick up your gold reserves and start purchasing with your currency with those gold reserves, and thus stabilize any massive load of short orders or sell-offs on your currency, which is floated onto the market. So you do have the ability to prop up your currency if the market was trying to fight down against you. And in common goods terms, gold was money. In the old times, you would have gold to be exchangeable to the bearer of the sum on the note. You would have all of these fantastical things which gold represents in terms of money. Now that we have paper money, we just hypothecate money into the air, and it's all gone into a massive credit bubble, which is spread around the world into the financial systems, and it's a very dangerous situation. Now, so just remember those aspects with China accumulating gold and being in that situation. Now, so we've got with China, they are a big importer of materials. They go around the world. They need to acquire all this stuff to produce goods, and then they produce a hell of a lot of factory goods, and then they sell them on. With that, they create a surplus. Now, coming back. We have China recently giving out on the news that they have increased their gold reserves by 60% since 2009. Now, the market was always very like, what's going on with China with those gold reserves? I wonder how they are doing with those gold reserves. And China, interestingly, never revealed that information for a very long time. There's a possibility and there's a theory behind the reason why they wouldn't provide this information is it was a fairly good thing. The fact that if you don't reveal this information, people will be like, oh my God, China's doing so well. You get this little notion that they must be doing so well. They want to keep this a little bit of a secret to themselves so that one day they're going to release this information to the market and go, hey, now we're going to create we're going to float the renminbi to the market. So there was this little bit of a cloak and then discovery, and you are unveiling this new mega currency, which is going to be the main means to which you trade and get yourself involved in commerce with. And that means that for that to happen, you need to have lots of reserves yourself. Lots of nation states need to get their own renminbi. Then you can yourself, as a government, can get into lots of deficit spending because everyone knows that you're the central dollar or renminbi or yuan. So just bear that in mind. Now, so they released that information, and that's quite kind of interesting. The thing that I'm thinking of in this sense is that they wouldn't really release that information other than for a good cause, and that leads us back to the announcement with not the announcements, but the market conditions in the Shanghai Composite Index. Now, last Monday, or yesterday, was it? Yes, it would have only been yesterday. They allowed short sellings of positions onto the market, and they said it was all free to trade. And they created I think they must have released this into the market. They've got this. The government has got a company which is theirs itself, called China Securities Finance Corp, and it had 3 trillion yuan at its disposal to prop up the market in a very short space of time. If there was any market turbulence. Now, probably we've got some expectations that may have been used. Simultaneously to that, we have a flash crash in the gold markets, and also China's announcement at the same time that of the actual reserves that they have. Now, all of these forces you can think, okay, that flash crash, are they Remember, this is all conjecture here. Are they just releasing some of their gold reserves? I mean, they can tell you whatever they like in their gold reserves. I could say I've got billions of dollars in my account, but yes, there's no way of you really telling unless you were very sophisticated in the way that you could attain my accounts. So you can announce that information any way you wish, and the market is going to react accordingly. I know that China always likes to give statistics of their economy expanding in GDP by a double-digit rate every year, continuously for years, and that double-digit rate of increase is sounds a little bit unsustainable to me in itself. So there is a lot of suggestions that there's statistical manipulation, and they use and the market starts to use other means to get the data, which will be like the electricity usage. I'm not sure exactly what they're looking at, gigawatts or whatever they're reviewing, and that's how you estimate how well they're doing. But going back to the gold flash crash, in fact, 1/5 of the entire day's traded market. So like this is how much the volumes move in the day. 1/5 of the volumes hit into the market in a massive load of sell orders in the space of only 2 minutes. So that is quite incredible for that sort of occurrence to occur while everything else is happening. So you think to yourself, do we have China getting a little bit scared, and then at the same time China, I mean, I guess this is going at the market of just the thing of saying how much gold reserves they got onto the market. That might just suggest to the gold market, I'm trying to like piece things together here a little bit, that might be a bonus to the gold market. That might pump it up a little bit because you're saying that you own more gold. Thus, you can potentially estimate how much is in the ground and how much material has been extracted, and how much, if it's in China's possession, China doesn't really want to get rid of it too much because they're going to release their future currency and all those kind of things. So the market would suggest, okay, well, they've got a 60% increase since 2009. That's a good piece of news for gold prices. Let's keep that on its upward trajectory. I'm not sure about that piece of information, so please correct me if my theory is bullshit there. So that, and then while that announcement happens, always look at the underhand. So while you get the public announcements, pretty much when you get a public announcement on the market, the government is trying to do exactly the opposite of what it's announced into. So it's just like a little trick. This is not unfamiliar to the market, and I'll give you a little bit of a story beforehand. After this, so then China, I'm not sure how much they are trying to hide the flash crash or anything like that, or whether it is in the market at all, but there does seem to be a certain amount of opposing sort of things which have occurred, and people have seemed to have noticed the sell-off. Maybe a flash crash, people have studied to be better just to stop the market going into free fall rather than just a sustained sell order which goes off throughout a whole day, which creates which might just push it forward. There might be statistical data out there for that. What is the best way to, if you're this massive humongous market king, what is the best way to change the market without you being noted too much? Do you do it in a big flash, or do you do it in a very sort of subtle way, like drip, drip, drip throughout the entire day or week or whatever? Something tells me it would be the latter, but maybe China required that money in a very short space of time. Maybe the money was all locked up, and maybe it was required because of propping up this humongous market forces which it was going up against. Now, remember, I'm going to mention this again. Conjecture. This is a conjecture alert. So just bear that in mind. Please provide me with any further information. You're probably going to be in the future by quite some considerable time, so you may have much better facts than I do right now. So there's market forces which occur in life, and the free market, as we are told, will always strive to fight you at every stage. So, going to a little story, you may have heard of George Soros. He is an American-Hungarian investor, speculator. He knows his FX trades. And in around about 1992, he went up and basically did a trade and traded against the United Kingdom's government. And he was successful in that, which incurred something in the region of an expense of $3 billion for the British government's purse. So incredible thing which had occurred. Now, from George Soros's perspective, just giving back a little bit of history. There was certain market forces which were happening there. The UK, there was like this European rate mechanism where everyone was trying to stabilise. There was time of the Maastricht Treaty, and they were trying to all get into this Euro system, and the UK wanted to be a big boy in town and have a fairly high valued sterling pound versus the Deutschmark. And the problem is that the German economy had been under a lot of free market principles, have been expanded and industrialized and had the correct people in place to put low taxation systems, and basically created the powerhouse which it still is today, but there is obviously still a lot of currency manipulation in that market. But some certain economists, you'll have to help me with the names here, but there was a certain economist which massively helped out the economy of Germany and put forward plans to keep a low tax economy running. The free market could flourish in that circumstance, and hey presto, you've got a very good German economy, which is about to enter into a Eurozone. Now, from the UK's perspective, there was a lot of issues occurring. Compared to the Germany side, we had high inflation. We had the pound going down against the US dollar, and predominantly we would make a hell of a lot of money of exporting our goods out to America, and that was kicking into our surpluses, our trade deficit, or surplus, whatever it would have been in those days, but I imagine it would have been a deficit. Then then, so in that sense, with this high pegging, George Soros decided to put a short order on the pound sterling, because he predicted that the pound would be weakened by the market forces, which is going to encompass it. Now, the pound and the British government wanted to keep that currency as high as possible, and was going to do anything it could to fight against anything in the market correction. Now, what happened after that? So you've got these two opposing sides of what two nations, a man, and which is George Soros, and the British government, and the power of all the taxpayers' money in a tangle between each other. Now, I believe that with this European rate mechanism, if the percentage went down below a certain rate, which was like 6%, and it was pegged at a very high point in the first place, then the British government would have to intervene. And it was trying to intervene against George Soros. It was buying its own reserves. It was announcing to the market as well that it was going to increase interest rates for the next day, and see, you got this little area where the government will come back and say, okay, we're going to do this, and the market will adjust to it. But what happened is that I believe that George Soros was playing on such a high margin that for every time the British government would try and move to raise the pound's value, George Soros's short order would outdo him, and then the market force in general would see this occurring as well, and they would all go into that scenario of going against the British government. Now, you like this ended up to make George Soros something in the region of 1 billion. Not sure, 1 billion of something. It could have been either dollars or pounds, but let's go with pounds anyway. But it was estimated that he made about £1 billion from this trade, and the government got itself into a position. I think it was on one day they said they was going to quit, and because they knew that whatever they was doing against it wasn't working, and they were just working out whether George Soros had put so many short orders against them that they couldn't control it. And then the next day they just checked the market, and they noticed it was still the market was still pushing against what they were trying to do in their directions, and they weren't capable of staving off this basically the market force of what they predicted for the pound. Now, since that, the pound was in an absolutely dire straits, because you've got a couple of factors just to consider in itself. If you've got it had high inflation, high interest rates at the same time. So if you're a government and you've got high inflation, generally your options are to actually increase your interest rates to stem off the rate of inflation, because people will have they want to save their money more, and they want to spend their money less. Because of the saving rates, which will increase, and they will also retract their spending. So because of the expense of getting out credit, so you won't be getting as big as loans out any further, because you know that you'll be paying a large margin. That in turn would have a force on the economy to lower the inflation rate. People will be demanding for cheaper goods, less goods, and generally the demand would fall on the economy at that point. So that is the market force of the inflation. But at the same time, they're trying to peg themselves high into this exchange mechanism which they think they can enter into at some point and have a very nice, tasty route of exchange when they enter. Also, so they've got inflation, they've got a higher deficit as well. If you have a very high deficit, you will ideally you would like to lower interest rates, because that would mean that you could basically you're charging less interest on the debts that you own, and you would be paying off less to your bond owners, and that's what every government in the world is doing right now. Going down to the bottom, going into negative interest rates so they get the money back somehow. So you had that market force as well. I remember in the 1990s early thing, I was over there myself, if you can tell the English or British accent, that the economy was crapped after that. The housing market absolutely shot itself to pieces. Even though it tried to raise its interest rates out by a little bit, it then had to sort of curtail it a little bit at the same time. I think it went from 15 because of the announcement, and then it had to bring it back down again. So there's a lesson there to be learned that I guess the British economy in the early 90s is nothing in comparison to the might of the Chinese economy nowadays. However, there is an important lesson to be learned there, that you one day will come up against the market, and if you try and manipulate the market and people perceive that you are manipulating the market, eventually at some point you will come a cropper. Now, there's no knowing how much manipulation is going in the market and how much China's involvement is. But there is a high degree of evidence out there to suggest so. And no matter how much you try and prop up a market, eventually the force is going to come against you. And then I expect there has to be that moment, as with the British government, is that we cannot sustain using taxpayers' money and propping up the pound sterling, because it is costing us too much money, and it did cost the government by about 3 billion at that point. And I wonder that there is this moment at a point where we go right, or where the Chinese go, or the Chinese state government goes, right, we have got ourselves to a point and we've got to make a good decision now. We can either throw good money after bad and prop up these markets, or, and this is the crunch point, we let this market go to the wayside. I guess there's a strategy where China doesn't want its market to crash first, and then I guess there's another strategy from the American side. They don't want to crash first. If you're the market to crash first, then the other country comes in and purchases at a great value. So there is that ideal from the mindsets of both governments. So there will be this propping up strategy at every expense. But at some point, that expense is going to be a little bit too much to swallow, and the numbers come out eventually. The truth comes out in the wash at some point, and you have to get good hard money out onto the market, like gold, and start using it properly if you're going to do humongous amounts of market manipulation to prop up and to stop a stampede happening in the Chinese economy. So it's interesting to think who might have profited from all of this. You might have had, well, it's right now you can only sort of think of it as that the Chinese government is really only the only loser. You might have a lot of people which had a lot of investments and been margin called and then told to get out of it, and then there's going to be a lot of blocks, and then they're not quite out of it, and there's been a save of skin there, which is interesting. The psychology of the market might start to think now that if this has happened before, it's a dangerous game we're playing. I think the good times, the good old days of like 10 years ago may be coming towards an end, and it's time for me to get myself out of this market. And it just takes a little bit of a time for a paradigm shift to happen, and dependent on how much speculation has been made and how many margin orders have been made onto the market, the Chinese government has to fork the bill of the speculation going against them. So who knows how much the manipulation has stemmed the flow of the problem. We don't know how much that's occurred. We don't know how long it could take before the next sessions of crashes, and then stock market holds, and then stock market preventions of short orders. There could be a whole new string of the same events occurring on a repetitive basis. It's uncanny how that has all been occurring at the same time as the Puerto Rico crash, not crash, but the bond default scenario come into realization, and the Greece default scenario come into realization. It's all sort of conjured in the mix. You've got to think that the bond market, the canary in the coal mine situation, when you was an old northern miner, there were certain gases, and you'd have poisonous gases when you was in this cave, and because this tiny little minute canary had tiny lungs, and it would pump the toxins around its body a lot quicker than what a human would, the canary would fall, and that would thus tell you to run out of that coal mine as fast as you can. So these are these little canary in the coal mine warnings of the future that could be. There's little signs of what governments can do around the world. The Cyprus scenario is always the most interesting to me, where they decided to, rather than the government getting involved with nationalising banks and putting all the money onto the taxpayer, and start getting a big debt for the future, which it has to pay off, which a lot of the countries have done around the world. The Cyprus government had confiscated the bank accounts, or a portion of the bank accounts. I know there's some weird thing going on with Russia at that point, or something else, but there was confiscation of savings in banks at that point. So there's all those little elements, these little warning signs which occur in financial markets, which give us little signals of what potentially could be happening. It's not certain, it's not for sure. There's a lot of things which can happen next, and I could be still here talking to you in another 10 or 20 years, and the same things could be still occurring up to, well, which my prediction is that we'll get to a point where there will be a humongous sort of default scenario, where a lot of things are not getting paid for. The money, the liquidity situation sort of dries up, and anybody who is in debt gets basically fucked over, and that's the business world or anything else. And it's one of the things that really did me in with my thinking is that I always thought that this stock buybacks was a crazy idea, because if you're buying back your own stock, so you're going out there and you're purchasing back your stock, you're just literally eating yourself again. So you're just saying, okay, well, all the profits that I've made, I'm purchasing back to buy my stock, and and that rises my stock price, and then that thus gives me more people that want to invest into my company stock. So it's not really like doesn't sound like the most fantastic way of investing in your company. Surely investing in better infrastructure, better efficiency savings, maybe designing new and better products which can be sold out to the markets. I guess efficiency drivers will be a lot more relevant, seeing that you can you're in a sort of a state of world recessions, but there you go. You get all of those suggestions, and yet people continue on the buybacks. And it was a very successful strategy for all the companies to do the stock buybacks, because US dollar has been doing very well as the currency of safety that all investors run to when markets start to look very volatile and strange, and is suggesting that there could be some kind of market issue. So interesting there. But I mean, the prediction is that if you're taking out, now remember this buybacks as well, it's not necessarily they're doing this purely with their profits, they're actually doing it with taking out debt. So they're purchasing debt and then buying back their stocks with this debt that they have got. So it's a kind of funny strategy which they're doing. You do not want to be in a position where debt market seize up, and then you have to really pay with real stuff, and then we get a situation where we really have to pay the correct percentage of risk from whoever the supplier of the money is, whether it's the bank or some person else. That's where you get the proper risk and reward scenario happening. And just like in the 90s, you have interest rates in the realms of something like 18%. I'm sure. I think UK was hitting around that range. Maybe America's a little bit lower than that, but there was humongous market corrections and the bond market is the one that never lies. Now, if you can manipulate the bond market by giving or printing lots of money and purchasing, as a government likes to do, they like to purchase their own debt with what they are rehypothecated money into existence, and purchasing their own debt orders by the means of quantitative easing, which is that beautiful little word which is tricky to understand. As soon as you say the word quant, you're like, what the? But anyway, so this debt accumulation is going on around the world, and it's pretty scary stuff. It comes to a point in which the debt expansion cannot continue any further. I don't think any nation state wants to be the first one on the block to go under that circumstance. However, unless you had this like ridiculous takeover of this megalomaniacal sort of country, I believe it will be the first ones that go through it will have the best strategies to get through the pain and suffering. They'll have the best understandings, and they'll be very learned, and they could potentially flourish into different nations and be the future of they could be the future saving grace of humanity. And there's a lot of lessons to be learned. I guess you could say that maybe there are countries that have already done this, like Zimbabwe and more of a Western Isles sort of country would be Argentina, and they're still in the throes of the governments trying to push it onto them, these different things. But yeah, interesting state of plays. Remember what I say, this is just a man's opinion. You decide on what you find is true from what I say. Do not assume whatever I say is true. That is the art of a philosopher. And yeah, if you've got any further information to support my claims, or if you've got any information to dispute my claims, please fire away. I am always willing to listen to any comments or anything else.